Hello and welcome back to the Degen crew. The prediction I wanted to go over with you guys right now is something I've been buying. I've been buying the price of oil that it won't hit 110 by the end of month of May. This is a super complicated one. The risk is pretty high. I'm definitely not going to do it justice. There's many variables, but let's hop into Polymarket and I can explain why I've been buying this. So if I go in here, the oil will WTI crude oil hit 110 by the end of May. I've been purchasing it around 37 cents as my average. Right now it's around 53 cents. I have a little bit of wiggle room on this because I'm up 44% currently right now, and I've traded in and out of it. I've already sold some, but I'm willing to buy more. I'm also willing to buy the 120. So if the price of oil gets closer to the 110, that means the no on the 120 would also drop. So this would go lower. And I'd be willing to double down around that as well. So if we get closer to 110, I'd start buying the 120. But the question is, why have I been purchasing this? And there's many reasons. There's many variables. There's, in my opinion, there's four possible scenarios, and I really wanted to focus on one of these scenarios with you. But so the four scenarios is a lot of this has to do with the war in Iran, and why is there a war in Iran going on? What's the purpose of it? What's causing the price of oil to go up? So number one is what we've been told is the US doesn't want Iran to have nukes, and that's been the front-facing statement this whole time is the war is happening because they don't want Iran to have nukes. Option number two is China trade negotiations. So using the war to drive prices higher, drive oil prices higher so that the US has leverage over the China negotiations, which also includes AI. Trump was supposed to go to China last month and he didn't. So there's actually a prediction right now of will he show up in China this month? And most of it's at 99%. He might actually be there right now or on his way. But Trump is supposed to go to China between May 14th and 15th. It's May 11th currently right now. They were also supposed to bring, I think, a Bombardier executive. So it'd be weird to say that you're bringing a Bombardier executive and then not show up. I also think it's still on his calendar if you go to the US government website. So the fact that this is priced at 99% means I assume he's showing up. That's also if they don't cancel on him. Option number three is US dollar supremacy. So blocking Iranian oil to force countries to buy US oil using USD. This also might help explain why the US entered Venezuela, so to increase their oil. Option number four is inflation needed, so higher oil prices to drive down the US national debt. So if I hop into the debt clock, the US has $39 trillion of debt and total unfunded debt at $107 trillion. So causing the price of oil to go up so that we have inflation, and then that inflation helps pay down the debt as a tax on everyone. So those are the four options I look at when I look at the price of oil. Three of those options, option 1, 2, and 4, to me are all kind of longer term options. The one I wanted to focus on with you is option number 2, is the US using this as leverage for Chinese negotiations. That to me is a short term one, and one of the reasons why I'm buying specifically the end of May price of oil, and not something like the end of December or end of 2026. I'm specifically looking at this one pretty short term. So to me, option number 1 is the hardest to prove because it's always going to be the front-facing statement. Option number 4 is we can keep an eye on it with the Fed. So if the Fed starts increasing interest rates instead of decreasing them, it means they want to fight inflation, meaning that they don't necessarily want the high inflation, and that sort of rules out option number 4. And option number 3 is U.S. dominance. So U.S. So it depends on U.S. The production of oil in the U.S. and if for example the regulatory treatment on U.S. producers gets softer, that would more support option number 3. But the one I want to focus on is option number 2. So this is because I should have an outcome by the end of the week. We won't necessarily know exactly what happened, but we'll know if it went well or if it went poorly. So if Chinese deal progresses in the next week, or at least if it gets close to progressing, you'd think there'd be a quiet back channel Iran softening almost immediately or by the end of the month. So meaning that they came to a deal with China, or they're getting close to a deal, and then they want to bring down the price of oil, depending on what they agreed on, and there'd be some back channel agreement to end the war with Iran, or at least tame it down. So if that was the case, if they were taming down the war with Iran, I think we should know that by the end of the week. I also think that that fits the midterm narrative, meaning the midterms are coming up in November, and Trump doesn't want a war during the midterms. It has made the Republicans look bad. But so option number 2 is really the short-term option and why I've been purchasing this. But what are my risks? So my risks for the 110 oil price specifically we are the 11th today, and if this is happening on the 14th, you'd think they'd be applying max pressure, or you'd think Trump would be applying max pressure. And Trump's negotiation style has been apply max pressure. So over the weekend, Trump didn't agree to an Iranian agreement, which might be the max pressure going into this meeting. So what I want to be doing, if that was max pressure, and I think the price of oil right now is close to $95. It might even be 97. Let's look what we have. Okay, it's higher than that, so 98.5. So if they're applying max pressure going into this meeting, and this continues to go up, that's my risk. My risk is that this spikes to 110 in the next few days. But the reason why I've been looking at this as a good opportunity, or a sort of asymmetric, is because I think most of the short-term war premium in oil is priced in. Some of the long-term stuff isn't priced in, like if the war goes on for another 2-3 years, or this oil supply gets attacked even more. So I think the long-term stuff isn't necessarily priced in, but the short-term stuff by the end of the month is priced in. So that to me means the negotiations, if they don't go well with China, the risk is priced in. But if they go well, then the downside isn't. So I want to be purchasing the 110 during max pressure moments. So any headlines that come out that they're using, that the U.S. is using to better their negotiations with China, which would drive oil prices up, and I'd be selling into any softness. So buy during max pressure, specifically the no, and sell into softness. So that's my theory, or that's my working starting theory. Again, I apologize. I said I wasn't going to do this justice. There's many variables here, but that's my working theory for the price of oil and why I'm purchasing the 110 right now. My risk is that it spikes up the price of oil in the next 2 days into this meeting, but I think that's really the main part of my risk is the next 2 days. Once the meeting starts, if the meeting goes poorly, I think that equals the war lasting longer, and that part is already priced in. So I'm going to keep you guys updated on this. I will be adding to the position, especially as I probably won't add today or tomorrow, but as the meeting goes on from the 14th to the 15th, I will be purchasing more of this one, the 110. And like I said, if we do get a spike to 110, I think I will go further out and buy the 120. The sweet spot in oil right now seems to be between $95 and $120. Every time oil reaches close to 110, either Trump or Scott Bessent says something or there's a headline that drives prices down. And I think that's mainly because the consumer is getting squeezed. They can't stand the price of oil or can't handle the price of oil being much higher. So yeah, I think the 95 to 120 is our sweet spot. I've gone far out on the risk curve, this is a high risk, high reward prediction right now, buying the 110, because I do think it is possible that you get a spike. But that's the risk tolerance that I'm willing to take for this one, and I know what I'm looking for, and I think I can also exit this pretty close to break even if I have to, because I do have. I think that was the advantage of buying it a little bit earlier when the price of oil was already a bit higher, and I have a 44% buffer. So yeah, we'll keep an eye out on this one. I'll definitely keep you updated through the week. I'm purchasing the no on 110, and if this is your first time watching the Degen crew, welcome to the Degen crew. Thanks for watching.